Why interest rates just peaked. And did the Fed pivot today? Wait a second. Is Trump actually going to be able to fire Jerome Powell? And how does this relate to the real estate market?
All right. Anton Stetner podcast number 61. It is May 1st, 2024. And the number one question I had was about this headline I saw. The Fed holds rates. What happened today? Because I have no clue. I just saw the thing. I was like, I need to ask Anton what's happening with the Fed and rates.
The Fed held rates, and that was no surprise, right?
They had a meeting.
They had their meeting. They didn't raise rates. Everyone expected that. The juice is in what came afterwards in Jerome's speech and in the questions. And so there's two things we really want to break down for you. And the second one's the most important. So first off, in his speech, Jerome was a lot more hawkish than usual. He came out and he said, inflation is still too high. We need further progress in bringing it down. And the path forward is uncertain. So one thing that he started doing is, in the last couple meetings, is Jerome felt a little too dovish, and the market responded to that dovishness. I think he was really on point at this meeting, and his talking points were right at it. The next thing he talked about how the economic outlook is uncertain, and we remain highly attentive to inflation risk. It will not be appropriate, and these are just quotes, it won't be appropriate to reduce the target or the Fed funds rate until we have gained a greater confidence that inflation is moving sustainably towards 2%. So what he basically said during this whole speech, and we have more things to go over, was we're not beating inflation fast enough. Inflation is stickier than we anticipated. And rates are going to be higher for longer. That was the hawkish part of it. He talked about how inflation is stickier and taking longer than previously expected. And then, of course, he said our favorite line, the committee will carefully address all of the incoming data, the evolving outlook, and balance the risk based on the totality of the data. But, and this is the but, and this is where I want everyone to pay attention to. Then he told us of the fundamental shift in the Federal Reserve. And most people will miss this because everyone thinks that for them to affect the market, it has to only be interest rates. He said at the meeting today, they decided to slow the pace of decline in our securities holding. Specifically, the cap on Treasury redemptions will be lowered from $60 billion a month to $25 billion a month as starting in June 1st. And so when I say that, the average person does not know what I just said. And we all go, WTF, Batman. It makes no sense what Jerome Powell just said. So we got to break this down. 1, this is the start of the Fed pivot. 2, this is the start of changing policy without them changing monetary policy. The Fed, in order to suck interest rates really low back in the ZIRP area, sucked on all of those mortgage-backed securities and treasuries onto their balance sheet. The Fed is not supposed to hold those super duper long term, so they've started selling them off. Well, the Fed was the biggest buyer for the longest time, sucking in the treasuries and the mortgage-backed securities. As they suck them in, that's what drove interest rates really low. So one of the things they can do to monkey with interest rates is instead of them selling it off at $60 billion a month, they're going to $25. This is a form of quantitative easing all over again by them selling less of them off their balance sheet. So in other words, the rate at which they're selling them off is slower. And as that slows down, rates respond. So I pick up the phone. I call Tony Blodgett. Been on Tony's podcast a bunch of times, New American Funding. And I go, Tony, bro, you understand bonds better than me, so I want to make sure I understand exactly what Jerome just said. He said, you're reading it correct. This is basically quantitative easing. I said, pull up your charts in the background. So he pulls up his charts. He goes, yep, interest rates just improved 40 basis points in the last like half an hour. And then he opens up his email and goes, oh, just got a ding on the email. Rates just got better. So we may have hit peak rates again in this cycle. But more importantly, this is them saying we're changing our direction. This is the start of the go signal for what we should be doing in the future. Now, second, this was just them changing their treasuries. They're not going to change their mortgage-backed securities. Now, realize if they slow down the mortgage-backed securities, that would change interest rates even more dramatically. So this is a pebble. This is just that one little step forward that the Fed is taking, but it's the first step forward to lowering rates. This is, in effect, slowing down the tightening of monetary policy. This is a loosening of monetary policy by them signaling this and starting this June 1st. But we are not getting the rate cuts. The market then went and priced in about, so we're at about 1.4 rate cuts is priced in right now. So the market didn't price in anymore. And then when he took a bunch of questions, he basically just said, we don't know when we're cutting rates, but it's not soon. And we got to wait for the data to come in. So I know you had questions in regards to this. What are you thinking?
Yeah, well, it was generally what the decision was because I heard that they didn't raise rates, they held rates, and then why. But my question after what you just said is them lowering from 60 billion to 25 billion, is that them doing less quantitative tightening or more so more quantitative easing? Are they one and the same? Like there's
yes.
push and shove?
Yeah. It's like a teeter-totter.
Got it.
And the Fed is not supposed to hold a balance sheet. Mm-hmm. They're not a bank. They're not a business. They're holding a balance sheet currently of treasuries and mortgage-backed securities. So they have to clear them off their balance sheet.
And that's called quantitative tightening. Because they shouldn't have been doing it in the first place.
Correct. Quantitative tightening is them selling it. They're just slowing down the rate at which they sell them off.
Got it. From 60 to 25 billion.
Correct.
Got it.
And though, what I need our listeners to get, and this is why you come back and hang out with us, this is a change in the direction of monetary policy.
Why would they do that, though, if inflation is up and people aren't spending as much and, all those variables that are making it so that they have to hold tight, maybe even raise rates? Why would they be doing this?
What do you think they're seeing that I think the average consumer is feeling?
Oh, they definitely feel that the average consumer feels things are tight and things are difficult and there's struggle and weakness in the market.
Bingo. The average consumer is feeling pinched here in the U.S. The Fed is starting to see that, which means they're seeing more data. So they're slowly moving in the direction because Jerome Powell wants to stick this soft landing. He wants to go down as the guy who survived the run-up in inflation, who survived COVID, who survived all of these things and didn't have to Paul Volcker the economy and destroy it. So I think that's part of it, number one. But number two is you're seeing earnings reports starting to show cracks. So for example, we live here in the Seattle Metro. Did you happen to see Starbucks earnings report?
No, but I've heard through the grapevine that they're not selling as many coffees.
Bingo. So Starbucks.
I'm even making my own coffees.
well, think about this. Everyone's getting pinched right now.
I paid $6 for a cold brew the other day. I was like, heck, never again.
So everyone's getting pinched. So Starbucks is considered a premium experience. So people are now looking for deals. So Starbucks is getting less consumers. So they were down quite a bit. And I forget the exact number, but it's a massive miss to the downside on revenue and sales. So if Starbucks, which is a good indicator of overall consumer behavior, is showing down, I think that's what the Fed is seeing in the background. I think the Fed is seeing in the totality of the data, the consumer's breaking, businesses are breaking. Oh, we've got to start slowing this down. But they didn't want to signal, because of exactly what you just said, they didn't want to signal this playbook. So this is the coach sitting on the sideline. They've got the clipboard up in front of the mic. They're calling the play, but they don't want anyone to see the play. That's why they held rates, because inflation is high. But they did this other thing that 95% of people will miss, but it's a fundamental pivot in policy.
And are we going to talk about it later? Because my next question is, what does that mean for mortgage rates?
Phenomenal. Thank you. Today they went down a little bit, but it means we've probably seen peak rates again in this cycle. One thing we were worried about, and thank you for being my brilliant friend who saw what I did not see, the 10-year's trending up. I was like, no, it's not. You're like, no. The 10-year treasury is trending up. And I'm looking at it on a larger time horizon. And then you're like, no, scoot it in. I was like, yep, you're totally right. That trend up is now most likely peaking and most likely rounding the corner. As long as inflation starts rolling over, and one thing he did say during the press conference is he said, one thing we're seeing is that we believe the rents are going to show up, because that's a lagging factor, but the rent data is pointing towards lower rents or rents staying flat.
Have you seen that?
Oh, personally, all of our rentals were flat, and then one of them was like, well, there was a dog. There was a canine from the police, and they had to come into our backyard because there was a police over here, so we don't feel safe, so we want $300 a month off. And so we politely told them, go fly a kite. If you want $300 a month off, we'll just sell the property. Then there was a little bit of miscommunication between our CFO and the property management company. And so the property management company just gave them notice. We didn't intend for that to happen, but literally they just got given notice, like, oh, we're not renewing your lease. We would have given them the same lease, but there was a miscommunication. But all of our rents for all of our rental properties have been exactly flat, and then one of them rented for $50 less.
And that is a pivot in itself.
It's a massive pivot.
Right? Because the question was, how crazy are rent prices going to get? And you're seeing the top. That's what's interesting about talking to you, because the Fed stuff is so broad and it's so beyond us. It's in like a whole stratosphere. But rent and mortgages and what's happening, with our neighbors, with your properties, that's something we can actually observe and know is true.
Yes.
It's not spun. It's not a narrative. It's not politics. It's literally just like what people can afford and what people can't afford.
And we're always trying to deliver, the unbiased opinion, like the facts and what we see happening here. And then we're trying to deliver what we're seeing on the ground. And what we're seeing on the ground is throughout most of the Seattle metro, rents are flat or slightly down. Which rents are down? The rents that are down are for the upper end A-class stuff in those luxury style buildings. The bottom end rent is up.
It's still going up?
Yes. The middle, flat. Okay, so when you put it all together, rents are actually slightly down overall, but it's not where the normal consumer feels it.
And what's interesting about that is it's kind of a problem that makes the problem worse, meaning why would the lower end rents go up? Well, it's partly because if people are moving away from expensive properties,
yes,
or they're trying to cut their expenses, then naturally
they don't want to pay $6 for a cold brew.
So they're trying to save money, so they go to the properties that are more affordable,
yes,
making it more unaffordable because there's more demand. But again, not enough inventory, not enough options.
Bingo. Bingo, bingo, bingo. What I want our people thinking about, thank you, those of you that subscribe and are with us on this journey, is that with the Fed signaling this, it means rate cuts are coming. Now, we don't know when rate cuts are coming, but late this year, early next year, okay, you'll probably see some rate cuts. But the monetary policy as a whole, the aircraft carrier is officially turning. Jerome Powell just said, I'm turning the aircraft carrier. So what you need to be thinking about is, how do I find good deals today? And I'm talking really hardcore investors right now. How do I find good deals today because I know better rates are coming? It's just a function of when. So I get the good deal that works today, and then I get the double whammy as rates go down.
Okay, so with that being said, next topic is our favorite politics, secretly. But of course, politics is such a big deal because policy will affect monetary decisions leading to mortgage rate adjustments and changes and obviously going up and down.
Well, and how people feel about politics affects the whole economy. And because it's always like feeling, and it's always fear of the unknown, So this was, and I don't know if this is true or not. So this just kind of blew my mind. Trump basically said through his advisors, I want to get rid of Jerome Powell and take away the independence of the Fed. Now, as someone who's like a capitalist, I go, yeah, I don't like that. I don't like the government sticking their fingers into things more. I don't like this at all. But then I was like, okay, we need to digest this. Like, what if this happened? Like, what would it look like? And what does this mean? And what should people know about, okay, if Trump gets elected, can he take away the independence of the Fed? And how does that affect us in relation to real estate? So the idea was, my idea was like, okay, why is he doing this? He said, if you're a consumer and you're being affected by high interest rates, by high inflation, let's go attack the man in charge of that, aka Jerome Powell and the Fed. Because if I can win the hearts and minds of the consumer, I can win the election. And all of a sudden I go, oh my, this is brilliant. Even if he doesn't have the intention of doing it, the signal here, I'm on your side, I'm for the little guy, I'm here to help because of pricing. So I flipped it around and said, well, what's Biden's position on this? Biden's position currently is the exact opposite. The Fed, you're doing a good job. We support what you're doing. Stay independent. So you've got these two separate narratives they're polar opposite. But how do people vote?
Narrative and spin of money. Yeah.
They vote by their pocketbook. So once again, I was like, oh my goodness. So I don't like a lot of what he does, but I was like, this is brilliant. Second, when Trump was president, this is when this inflation started. And if you remember, he went and attacked Jerome Powell in the press multiple times about his actions. So this is also retribution, retaliation. This is the little kid throwing a fit because he didn't get his way. So he's literally signaling, again, if I get back in office, I'm going to do everything humanly possible to get you fired and to take away your job. Well, what does that mean? It means I blame you for the high inflation. It helps push away the fact that the whole government was culpable and involved and basically created this inflation. It's using the Fed as a scapegoat. Then my brain was like, okay, well, what else? What are we not thinking about? Well, now it comes up with the Fed is the Fed going to act political? Are they not going to act political? And then most of the people listening to this are like, you know what? They're always going to act political. So I don't want to argue, but you can tell me I'm wrong in the comments. If the Fed now cuts early, after he said this, he can then call them on the carpet that they were supporting Biden. The Fed may also cut early in fear of retribution, retaliation, and losing their job. The Fed may also cut early if they believe Trump is going to get elected and they don't want to face the wrath. Really weird politics comes out of this. I don't know which way this is going. I'm just throwing out ideas here. Because historically, the Fed has been politically independent. But now flip this around. If they wait to cut too late, you know they're going to get fried again and called political again. So the Fed, any way you look at what's happening right now, is being backed into a corner where they will be villainized, regardless of Biden or Trump wins, regardless of where the economy is, and then used as a scapegoat. I expect, this is my prediction, that both presidents will start speaking out, the current president and the incumbent will start speaking out about this more. Now, what does this mean for us as real estate people? I think by Trump's aggressive nature, this actually helps rate cuts to happen sooner because they don't want to be seen as political. And you know that he's going to do everything humanly possible to get rates lowered the second he gets in office. Why?
Because people vote with their pocketbooks and he wants people to like him.
And he's a real estate guy. They vote with their pocketbooks. That gets him elected. His money is made in real estate.
Good time to buy.
Good time to buy.
Right at the beginning.
So we're getting signals. And so this was really weird. I understand last week I was all doom and gloom. This week I'm like, dude, it's game on like Donkey Kong.
Last week was a nuclear bomb on the thumbnail. This week is money printers.
Yeah. This week is like money printer go Bert because we're back to quantitative easing. We've got political pressure to lower rates, and we've got self-serving people trying to help themselves when they get into office and feed their own pocketbook. So I'm just saying, cool. They're showing you the playbook. Go feed your pocketbook too. Lastly, the other thing to be thinking about in regards to this is Trump is extreme pro-U.S. and pro-U.S. business. So if we lower interest rates, it weakens the dollar because it takes away some of that dollar strength. And it helps U.S. businesses and U.S. exports. So that's part of his political platform too, is strong U.S. businesses. So he's telling you once again in this playbook, I'm going to fight the Fed. What's funny is when you look at it, there's that old saying of don't fight the Fed because you will always lose. If anyone could win and make a difference, it would be Trump. It wouldn't be Biden. He's not politically strong enough, nor has enough youth and vitality and fight in him as a person to fight the Fed. He's just going to agree with it. For our real estate investors and our home buyers, what I want you to be hearing is things like this. You're seeing that the Federal Reserve is signaling. You're seeing that politics is pushing towards this right now too. This is indications of buy signs. And that's why when I was talking to Tony, when I called him about the bonds, I was like, bro, it's go, baby, go. He said, it's go, baby, go. I said, you want to go buy something? He's like, let's go buy something. So I'm talking to another investor, and both of us, we see this. We're like, oh, these are buy signals. Let's rock and roll. I get it. The average person's going to say the economy sucks. You shouldn't be buying right now. That's fine. Don't go make money. I don't care. I'm going to go make money. My homies are going to make money because it's these little windows that pop up like this where you get these little signals that no one else is paying attention to. Everyone else listens to the fear in the media and goes, it's a bad time. When everyone's saying it's a bad time, it's the good time.
Can you do me a favor?
Yes, sir.
Break that down for me, why you and other investors say it's a buy season. What are the windows that you're seeing specifically?
Let's go back to Warren Buffett. Warren Buffett, we've said this before. You should be greedy when others are fearful. And the reverse of that is fearful when everyone is greedy. So what's happening right now? Is fear up or down in our economy?
Up.
Fear is up. So there's a signal. 2, is the media telling you everything is good?
No.
No. So you're getting the signal. 3, the Fed, what did they show us today when they changed their stance on how much they were selling off of their balance sheet?
They are fearful of some of the numbers.
Bingo. They're fearful. Things are changing. So we're getting these signals. And then here in the Seattle Metro in our market is appreciating rapidly. I get it. Not all the markets are like that, but we're getting buy signals. what you do is then we're looking at interest rates. Interest rates probably just peaked again. As it comes down, it's going to become easier to buy. Now I want to flip it over. Have we talked about, and our subscribers know this, there's pain in the commercial market. Is that pain getting better or worse today?
Worse right now.
So it's getting worse. And everyone goes, I want to buy at the absolute bottom. You don't buy at the absolute bottom. You buy anywhere near the bottom. Don't try to time it. The signals are showing up. You're nearing a bottom. So they did this forum, symposium, whatever. They got a bunch of people together about commercial real estate. I wasn't going to go into this, but you led me there. And they said, what needs to happen to prevent the commercial real estate crisis? Banks can extend. We cash in refinances, sell the asset. Cool. How do we incentivize cash in refinances without giving a bailout to commercial real estate? So there's talk and rumbling in the background right now of creating tax incentives for cash in refinances, for creating other incentives of asset trading, for giving things to the banks to help with that cash in refinances. Because if they don't deal with it, we know this is a $4.7 trillion problem. Now, is it all going to hit at once? No. But if it did, that's a problem. So all of a sudden, the commercial real estate industry is lobbying in the background and pushing in the background for their own version of a bailout. So they're working on a bailout. Well, if they're starting to work on that, there's another buy signal. Okay? The other thing that's happening is, and I talked about this last week, but it's worth bringing up again. This week, I got 2 more phone calls from other builders. Hey, Anton, what do you got? And one of them specifically came into the office, sat down with me and said, hey, what permits are you holding out on me? I know you got some permits hiding in that pocket of yours. You've always got a couple deals hiding up your sleeve. And I was like, yeah, I got permits. What you want, bro? I got what you need. And he goes, what could we build tomorrow? I got some stuff in Stanwood. He goes, are you going to build it? Yeah, I got some stuff in Marysville. You going to build it? Yeah. I go, but I don't have to. I go, what do you want? He goes, there's 2 things you should be doing right now. You should sell it to me or let me put in a fee build because I have a hole in my schedule. A fee build is where you pay someone else to build it and they just bang it out for you. And the reason I bring that up is that's another buy signal. When builders are specifically hunting for inventory here in the Seattle metro, they're saying, we trust what's happening. So what everyone doesn't understand is I'm so freaking conservative, it's not even funny. So I don't look for one buy signal. I look for 5, 10, 15, and then I start spending my money. When bigger money is calling me, the little guy, asking for my deals, I'm like, it's game on. Let's go. Got a call from my friend, mentor, business partner today also. And he was giddy. And I go, Mike, what's going on? He's like, I feel good. He's like, sold a bunch of stuff, got 3 more things under contract. I was like, wait a second, you were really pessimistic here in first quarter. He's like, it's go time. So when I get the people calling and saying, hey, it looks good. Now, the whole economy is not good. This isn't the right time for everyone. This is the right time for the savvy investor who wants to make money, who has some cash. If you don't have cash, sorry, this is not the market for you to play in. Another piece of data, because you asked data, talking to a commercial broker. This commercial broker specializes in retail spaces. Okay, well, we know office is the worst. Retail is like the second. I said, hey, how's your business? I'm asking everyone. She goes, my business is killing it. Most people are not doing that well. I said, okay, well, what do you think? What's different? She goes, 1, I've been doing it a really long time. 2, and I'm calling everyone. 3, I'm turning over every walk. I'm doing every deal possible right now. I said, well, what do you think? She goes, it's a buy time in retail. I was like, wait a second. Why is everyone telling me to buy this week? Last week, I was iceberg dead ahead. The ship's sinking. She said, what's happening with the commercial stuff we're selling right now is people are coming in with cash or large down payments. They're getting discounts. They're getting good performing assets at higher cap rates and then discounts off the purchase price. She goes, you got to be able to stomach high interest rates and more money down. If you got cash to put more money down and you can stomach the high interest rate, she goes, I would buy right now, Anton. She's like, I'm trying to buy something else right now. And this is a large commercial retail broker in our area in a sector that's not doing as hot as everything else, saying, cool, it's buy time. So I'm just telling you what I'm seeing in the market.
Yeah, it reminds me of 2010 and 11 when it was kind of the tail end of the really bad season and nobody wanted to touch anything. I remember houses sitting on the market forever.
Yeah.
Like sometimes 6 to 12 months.
Yeah.
Longer than that. And that probably hurts a lot of buyers listening right now who things are gone like that. But that was the best time to buy.
100%.
And that's when the prices were the lowest. And that's what's kind of freaky and crazy about right now. It seems like the house prices are the highest it's ever been, which it has been. What would be scary is if 5 to 10 years from now, we look back at this time and say, man, things were so cheap back then. We couldn't have even imagined.
So what I've learned after 2 decades in real estate, and if you don't believe me, go find an older person who's in their 60s, 70s, and 80s who's played real estate for greater than 20 years. And ask them if they ever bought something that they felt was too expensive. And then ask them the next question. What'd you think about that asset a decade later? And then ask them the next question. What'd you think about it 2 decades later? They all tell you the same story. You've got to go to the wisdom. Like I've got the gray hair, but you got to go to the wisdom. The people have been doing it 30, 40, 50 years. And they say, some of the assets I bought, I go, man, I overpaid for that. Oh my goodness, that was expensive. And a decade later, I said, man, that was a good investment.
Should have bought more.
Should have bought more. 2 decades later, I said, man, I'm a genius. It was the best investments I ever made. Because time in real estate is the great thing. So I hate saying this because I know how expensive the Seattle Metro is. We're going to look back a decade from now, and there will not be a starter home under $1 million in the Metro. And you'll go, oh my goodness, I should have bought when rates were 7% and it was unaffordable. Because we're that far behind on housing. That's why builders are walking through the front door of my office asking if they can pick any permits out of my pocket. In 21 years, that's never happened, bro. They don't come see me face to face. They call me on the phone. The fact that they were out hunting face to face for the permit should tell you how low inventory is. And then that number, of course, has showed up in the increase in prices here in the Seattle Metro. Now, I get it. The rest of the country is not exactly like that. Your county and your city is going to be very specific. My market's on stupid fire right now.
Well, on that note, what is the market update for Seattle right now?
The quick market update. And what we're going to do is this will turn into a live stream sometime next week that you can join us on.
Make sure you subscribe and hit the bell so they're notified of the live stream.
Amen, bro. You're good at that. I appreciate it. Is that right now, the market has out appreciated what I expected this year. You are seeing upper single digit and double digit appreciation depending on what city you look at here in the Seattle Metro. I'm talking 7 to 13%. Oh my goodness. When you asked me last year and we did our predictions for this year was like, we'll hit 5, we'll hit 6. We've basically almost doubled that, and today is May 1st. closings are up. So closings for 2024 are outpacing what we sold in 2023. And pendings are up even more than the closings. A pending means they accepted an offer, which means closings are going to go up even faster. Supply is right about the same, but still very low. We're going to call it stupid low, technical term. So what's happening is the bidding wars are more fierce in 2024 here in the Seattle Metro than they were in 2023. And the whole market is selling over list price. Yes, there are still some deals. Showings to pending are down. Okay, when you look at showings to pending, you go, why is that down? That means as soon as people walk through the door, they're making offers. That's how fast this market is happening right now. The offer review date, back. So in summary, it's out appreciating what we thought. And 2024 is hotter than 2023. And so I know a lot of our audience is real estate people. Real estate people, you need to be outperforming the market right now. If you're not outperforming the market and taking your unfair share, you need to look at your lead generation model. And we need to have a discussion about what you're doing and how you're doing it, because the market's rising. And I'm still getting calls from people who are saying that they're not being a part of this wave. So if you're not participating, what is it telling you? It means you're not plugged in. Okay, you should be capturing this wave. My team is killing it. They are capturing this wave. I get a phone call from Ashton on our team. We have this 80-acre piece listed. And she goes, hey, I'm going to bring you another offer on this property. I said, okay, who's it from? She names a last name. And I said, oh, I know who that is. Cool, that'll work. And I said, well, what did they do? She goes, oh, they are doing a 1031 exchange currently, and they had just sold 2 properties. So they want to buy something like this and pay cash or get financing. I said, great. From that buyer, we'd love to look at an offer. We still have those 2 other offers that we're kind of monkeying with, but that buyer in particular is great. That's someone who has money. And so nobody likes this. I'm just going to say it. The people who have money are going to make wealth in 24, 25, and 26. Those who have assets are winning. And so if you don't have assets, here's what you can do. You can become the deal guy. Go find the deal, then pitch the deal to someone. And if the deal is good enough, the cash will show up. And how you get the cash to show up is you start hunting for the dear Aunt Tillies in your life who can help fund the deal. But if you don't have the deal, you'll never find the money. So find the deal first. What everyone wants to do is they want to solve the problem and have the money and have everything figured out. Just go find the deal. I'm looking through Twitter for this. I always go look, read all the headlines. And they said, wait a second, there's a meme from The Office. And the guy goes, so the government printed a bunch of money and caused inflation, but then it meant we had to go buy a bunch of assets, which creates more inflation. So then they could tax us more to pay for the inflation. And I was like, oh my goodness, that is so spot on. It's just this vicious cycle that we're stuck in of you got to buy assets to protect yourself, but the government's going to get more taxes from you. And now have you seen that proposal about how they want to tax you on your unrealized gains?
Yeah, it's like 25% or something like that. And
Yeah.
It's like they're going to raise the highest tax bracket to 45%.
They had talked about taking capital gains to literally the highest it's been since World War II, and how taxing people on unrealized gains, both in real estate and in the stock market. If you want to destroy our economy and make it so we don't even exist, that's how you do it. Because here's what that would do. It would create massive unintended consequences. Let me explain. If you don't know you're going to have a tax bill, And all of a sudden, because of your stock portfolio or your real estate portfolio, you get hit with a tax bill. How do you come up with that money?
Do you inflate things?
No, you sell something. So all of a sudden you have to sell something.
Oh, got it. You as a consumer.
You as a consumer.
Yeah.
You got to go sell something to go pay the stupid tax bill. So you go sell something to pay the stupid tax bill, which creates more taxes. And so it's a vicious cycle. What that does is that's one of those things that massively would prevent people investing in the U.S. economy growing. So I hope that's dead on arrival, but I understand why we're doing it. Because the government's spending too much money. We owe too much on entitlements. Okay, we pounded through stuff really quick. Thoughts, questions about things that we went through?
No, the only question you kind of hit it was this could be a whole nother podcast. I think we should dive into it right now because there's such a low inventory of homes. It makes logical sense to get into the home fixing, home building, or just land development business. How does somebody get into that doesn't know anything about any of those things, but they might not have money or they might have money. They just know, hey, logically, supply and demand, there's not enough supply. There's a lot of demand. In fact, it's going to grow in the next decade, like exponentially. How do I get into the home building and fixing industry? Where do I start? That was my question. You kind of talk, say, hey, be the deal person.
More important than that, if you're going to be the inventory creator, what you would do is you would specifically go to the flippers, the home builders, and the land developers. And you would say, what is your buy box? And you would figure out what their buy box is. And then once you understand their buy box, then you go be the deal guy. And as you're making the deals, you turn around and feed them to the buy box. And you're going to need between 5 to 20 people in each category. And you go hunt the deals and turn around and feed them. As you make money, you say, hey, how are you doing this? Teach me about this. And we'll do a deep dive on this one because this one's really good. I agree with you. We should
Somebody just asked me that wants to get into it.
We should record a whole thing about this. But that's the quick, short version. You need to figure out what people need and want. And then you need to figure out how to find that, and then you plug that together. But we can get into more details. So subscribe, be around for more. And as always, you can catch us at resg.com. Thanks for listening.